Hi, I'm Marissa. I'm the brand specialist at Berks Homes, and today I'm here with Loren from Univest, and we're going to be talking about different types of home loans. So Loren, what is an FHA loan?
An FHA loan is a loan that requires only 3.5% to put down. It is governed by the Federal Housing Administration and was created back in 1934. Back in 1930, the Great Depression hit. To stimulate the market, this low down payment home buying financing program was created to get more people into more homes.
So is an FHA loan used for first-time home buyers? I've always heard that.
Absolutely. However, you don't have to be a first-time home buyer to get an FHA loan. That's one of the misconceptions that people read online. FHA can be used for a repeat buyer. One consumer can only hold one FHA loan at a time. So if you're currently in an FHA loan, selling a house to buy the next house, once that property sells, you now qualify for another FHA home loan.
So can anyone qualify for an FHA?
Anyone can. There's no income limits. There are loan limits in county areas for the most part, but everyone can apply. This is probably, for most lenders, a very standard first-time homebuyer program who have clients who have challenged credit, low credit, a short work history, limited credit. So it does have a little bit of level of forgiveness for customers who aren't in the 700s, 800s, have the 20% down and such.
So what is a conventional loan?
So the conventional loan is loans that everyone aspires to be and get into. They're governed by Fannie Mae and Freddie Mac. They're the insuring body who basically sets the guidelines for every lender out there to help finance homes. So these are the traditional conforming loans. Right now the conforming loan limit is $766,550. So as long as you're borrowing less than that, conventional home financing is probably right for you. This particular financing, you can put as little as 3% down for first-time home buyers. Repeat buyers, you need a minimum of 5%. And then from there, you can put as much money down as you would like.
So what is the difference between a 15-year loan and a 30-year loan?
So the amortization calculator is a bit more aggressive. So on a 30-year, you obviously have those 360 payments, which stretches out your principal and interest. On a 15-year, rates are typically less than a 30-year, so they are more favorable. However, the principal and interest payment is a bit more aggressive because at the beginning of a 30-year fixed rate, a fair amount of what you pay every month to your principal and interest is more interest than principal. Once you get into a 15-year loan, you've got a few years of that before you start balancing out and applying more principal.
So on the other hand, then what is a jumbo loan?
So the jumbo loan is financing anything over the $766,550. In that particular case, you have different guidelines than a conventional home loan. Typically a little bit more money down, probably more like the 10% or better. And then those are based off of completely different rates than the conforming loan limits are.
So what is a USDA loan?
So USDA loan is another government-funded loan. It's to help stimulate rural areas. This does have a few parameters or characteristics that you have to follow. USDA, number one, the address has to be in a qualifying area. So as long as you're not in a borough setting, you can pretty much look them up. USDA has an actual website. You can search the address and either it's a green or a red, which obviously are those indicators, yes or no. And then on top of that, you're gonna have some income requirements. So based off of a household income. I'm from Cumberland County, so I'm more familiar with that area down there. So if you have a family size of up to 4 people, your income limit for a household can't exceed $114,800. 5 or more bumps up to, I think, $128,000, $130,000. Don't quote me on that, but it's pretty liberal when it comes to the income limits. So USDA financing then requires the borrower to put no money down. It's a 0 down payment program. Credit score, you've got to qualify with an acceptable credit score, and then debt to income ratios are pretty particular. So because you're putting no money down, the underwriting guidelines are a little tighter because they don't want the borrowers to be too overfinanced and unable to make those mortgage payments.
So as a loan officer, do you guide a potential home buyer into what type of loan they should get?
Yeah, they kind of guide me, to be honest with you. They come to me and it's an interview. They sit down, we talk candidly about their goals, payment-wise. We talk scores, we talk where they want to live. So, and obviously knowing if they're a first-time home buyer or not, it helps me sort of take them in a direction to give them financing options. So, the stronger the credit, the little bit more money they have to put down, obviously would give them a few more choices to select. Those with less than perfect credit, we still work with them and guide them and help them. So they may have one or two choices to choose from. But in reality, the customers are basically the people who kind of tell me what they want, and then I kind of help them point out the programs that are best suited to them and let them pick.
So what is a VA loan?
VA home loan is set up to help our servicemen and women who have served our country to purchase a home with no money down. It's an excellent program for those who qualify. They have to either have been active duty and served for a period of time, or in reservists, they have to have completed so many years to accumulate enough points to be eligible for a VA home loan. But this is probably one of my favorite ones to do. Being from Central PA, we have many military installations, Fort Indian Town Gap, the Navy Depot, Army War College in Carlisle, in helping them serve our community. The correct candidates, like I mentioned, don't have to put any money down. Interest rates are a lot more aggressive, meaning they're a lot lower than the conforming interest rates. And one of the characteristics of a VA home loan is that you do not carry any PMI or monthly mortgage insurance on the VA home loan. So this helps make financing for veterans a bit more affordable because of this combination of low interest rates and no PMI.
I'm about to enlist right now.
It's excellent. It's
Nice.
excellent.
That's great. So how do I know my monthly payment based on my loan amount?
So how you're going to know. So we're going to pick a loan program for you. And let's just say that you're a conventional home buyer, you're buying your first home, you're putting 3% down on your loan amount. We would then be able to know what the property taxes would be. You would search for your own homeowner's insurance. We would know what that is. And we will annualize those totals to break them out over a 12-month period of time to help amortize your principal and interest payment, which is what you're going to pay back to the bank. And then we're going to be collecting your escrows with principal and interest, the taxes and insurance. And if you don't have 20% down, the mortgage insurance. So as you hone in on a house and have a property details, we can get pretty close to what ideally your monthly payment will be.
So do you offer a mortgage calculator, for
Yes.
someone to play around with?
Absolutely. On our website, you can go on our website. There's a mortgage calculator to play around with. Working with me, there's many scenarios where my customers will email me. We're going to look at a house tonight at this address. Can you please run some numbers? So it helps myself and my production assistant look more accurately at the property, knowing how much you're putting down, seeing what the taxes are, and then estimating what homeowner's insurance is. We can give our customers a pretty good 90% idea of what their monthly payment's going to look like.
So when someone gets pre-approved, do you give them how much they can afford on a house total or a house monthly payment?
So the borrowers are more or less geared towards a payment. So, everything hinges off of your debt to income ratios. And once we pull credit, once we have income verified, that sort of sets the precedence of how high can I go shopping for a house. So a lot of times now it's more how much is my payment going to be versus how much can I borrow. We do get a few people who are looking more at the purchase price of the home, but a lot of people focus in on the payment side.
When you get a pre-approval, how long does that pre-approval last?
So a pre-approval lasts for as long as the credit report is. So credit report lasts for 120 days. So your pre-approval is good for up to 120 days with that credit report, subject to still having your job and all the other qualifying factors you come to the table with. When you originate loans and you talk with customers, you almost have to hear their story. A young couple, they're buying their first house and they're planning on having a family. It's great. You don't ever want to discourage anybody from doing that. But letting them know that employment, if we're looking at both spouses' incomes, that we want to make sure that everyone is still employed when they go to the closing table. With lending across the board, there's the 10-day recertification of credit or soft credit pull, re-verifying of employment prior to going to closing. So a lot of things that get done at the beginning of the loan that also have to take place at the very tail end of things. So listening to customers as they get pre-approved is important, because if I'm hearing that there's a child on the way and it's going to interrupt a work flow for one of the spouses, then we have to have the conversation about maybe not being able to use that spouse's income if they aren't going to be receiving any income or planning to be a stay-at-home parent at that point. So,
does it change for someone that's self-employed?
It does, yes, it does. Self-employment is a great thing for people who are very business-minded, entrepreneurial. But for financing, it poses some problems. They need to be self-employed for a minimum of at least 2 years to provide a lender with 2 years worth of proper tax returns. Self-employed borrowers basically earn their money pre-tax, and so their tax returns are where they declare their taxes, their write-offs and everything. So in order for the industry to get a baseline of how much they're making, you need to have at least a 2-year minimum of self-employment and federally prepared tax returns to account for the income that they're declaring on their tax returns. So you may have a consultant who works from home and brings in $200,000, but through expenses and items that they have to pay to keep the business running, they may have $75,000 worth of deductions. So now their $200,000 income is reduced by $75,000, and now they're at $125,000 worth of income. Unlike someone maybe like you, where you get a biweekly paycheck, everything's on a piece of paper, you've got your taxes taken out, it's much easier.
I guess coming from the perspective of a young person looking to enter the home buying journey, how does student debt or student loans impact?
Yeah, unfortunately, the burden of student loans is a real thing right now. And, coming out of COVID protocols where we could push them off to the side and not really have to deal with them in forbearance, they're now going into repayment statuses. So from the lending perspective, depending if you're looking at FHA, conventional, VA financing, they all have their own characteristics. Ideally, we would love to pull credit and see them already established with minimum payments. However, we might need the help of the customers when they show a zero balance or they're currently in school. We would need to get a letter from the student loan agency identifying how much that minimum payment would be. Student loan companies are actually taking the proactive measures and providing what's called a mortgage letter on most of the websites, so they know that this is a thing for people getting into homes. Even for ourselves, we may have had parents who have had to co-sign for those loans. Well, it's impacting mom and dad too to possibly go and finance the next house because of this outstanding debt.
As someone that's purchasing a house on their own, is there an option to have someone help them with that payment?
Yes. They can get a co-signer to go on the loan. So, you have single individuals coming out of school or leaving trades, going out on their own who wants to purchase because rent is so expensive. They can get a non-occupying co-signer to go on the loan with them. That helps them afford the homes that they're looking at, with the expectation that the co-signer is there as a safety net to make sure that payments aren't missed.
How should I go about refinancing my home due to interest rates?
So again, refinancing is the option for customers in this current rate environment to eventually expect rates to come back down. Getting into a house today, if you're signing on a mortgage that's at 7%, you want to be aware of the market as a homeowner, that once you get at least at a 0.5% below your current rate or more, then it's great to go back and talk with your loan officer you worked with on purchasing your property to run numbers on refinancing your house. So it's more or less a great opportunity for customers to help save on a monthly basis with their mortgage payments. However, when interest rates do drop historically in the past, we've had customers who may have been 5 years into their 30-year fixed rate, and because of the change in rates have dropped, they now can afford a 15-year mortgage and jump ahead 10 years worth of interest and continue to compound the savings that they would not pay in that interest by jumping ahead on that loan.
So if you have the opportunity to, what are some ways to pay off your loan faster?
So paying your loan off faster, there's a lot of different ways. Traditionally, making one extra principal and interest payment a year helps shave more than 5 years off of a 30-year fixed rate. So if you can, sign up with bi-weekly payments, just like your bi-weekly pay schedule. You get an extra paycheck every 6 months. So likewise, on a bi-weekly pay scale with your mortgage, you're going to be making, on those months where you have those 3 pay periods, you'll have 1.5 mortgages taken out in 1 month, and then 6 months later the same, which would basically encompass paying 1 extra principal and interest payment a year. You can do so as well with just a simple check directing to the lender. Specifically, you want this applied to principal, paying off your mortgage or paying down the mortgage quicker and sooner. You have to direct your lender as to what you want to do, keeping in mind that you must fulfill your current monthly mortgage payment first before applying anything extra to the loan.
What are some of the consequences of a low down payment program?
Programs like VA and USDA, where you're putting nothing down, you're borrowing basically your contract price. It's developing the equity in order to possibly sell your house. So, committing to these financing programs, you're expecting that through rate of appreciation, your house will continue to grow in value while you're paying the loan down, slowly on a 30-year amortization. So, the jeopardy of the low down payment programs is you need to be committed to the house for a longer period of time, 6 to 8 years, and expect to know that that would be a period where you would develop equity to be able to list the property and pull, have money left over once the mortgage is paid off to use for your next purchase.
So say I have a mortgage on a house, but I wish to rent that house out. Can you do that?
So in the lending world, it's a very treacherous dynamic. And again, it just depends on which type of financing you're dealing with. Loan applications are taken off of intent. So someone coming to me saying I'm going to occupy it as my primary home, we work with those guidelines to facilitate the loan as a primary home. At any given time, a year, 2, 3 down the road, if a single person now meets someone else and they have a larger house to live in, departing that property and putting a renter in there is a good option. Making sure you've got the proper insurance coverage on there as well, and notifying the lender of what you're looking to do. So in the occupancy status, there are different interest rates for a primary person buying their first house or second house or third versus a second home, where the down payment requirement is a little higher. Interest rates change and go up because of the risk of a second home, and then you work into investment properties. So every person can own their primary home, have one primary home in their life. One person can have a second home, and then you can have as many investment properties as you'd like. So in these different scales of home ownership comes with different underwriting guidelines, comes with different down payment requirements. So, back to your question about turning your primary home into a rental, it's always best to check with your lender, make sure they're on board with everything, and they understand what the dynamic is, and go from there.